What's going on, everyone? My name is Andrew and welcome to Real Estate Basics. Today we're going to wrap up our discussion on the tax advantages to owning real estate. Now again, I will preface this with I'm not a tax professional. This is purely for entertainment purposes, and I strongly urge you to seek advice from a licensed professional. Specifically, we're going to discuss how to access the equity in your home by talking about a cash out refinance and a home equity line of credit. But first, let's talk about what is equity. Well, simply put, it's the value of your home minus the outstanding loan. So say you purchase a single family home for pure rental, so your lender required you to put a 20% down payment, resulting in a loan that is equivalent to an 80% loan to value for your outstanding principal. Your down payment, that 20%, makes up your equity. Well, over time, as your tenants continue to pay down your principal for you, your outstanding principal on that loan will go down, and appreciation will cause the value of your home on average to go up, resulting in your equity growing over time. Now, what happens when this equity grows to such a value that you think you could use it to go purchase another property if you had that cash in your hands? The first option for accessing the equity is to use a cash out refinance, right? So as we said, your equity goes up by principal paydown and appreciation. Cash out refinance will give you a brand new loan that replaces your current loan, and the difference between the two will be given to you by the lender. Now, they typically will only give you 70 to 80% loan to value to ensure you still have some skin in the game. Now, this is tax-free money, but remember, because now you just got a new higher loan, your monthly principal and interest will go up. And don't forget about closing costs, because those are associated with getting the new loan. Here's yet another simple spreadsheet to explain how a cash out refinance would actually work. So let's say 5 years ago you purchased a property for $150,000 with a 20% down payment, resulting in a loan of $120,000. Well, fast forward to today, your outstanding loan due to principal paydown is now $100,000, and due to appreciation, the most recent appraisal was $225,000. resulting in an equity of $125,000. Well, for cash out refinance, you could go get that new loan for $225,000, and your lender will typically require 70 to 80% loan to value, so let's use 75 for argument's sake. That will result in a $68,000 check going straight to you, tax free. Now remember, you now have a higher loan at $225,000, so your monthly payment will go up. Another option to access the equity in your home is through a HELOC. It's similar in nature to a cash out refinance, except you don't actually get a new loan. Instead, the lender or the bank will give you a revolving line of credit based on the equity in your home. Now, there are still fees associated with obtaining the HELOC, but they're typically less than a cash out refinance. And again, the lender will typically only allow you to withdraw up to 70 to 80% of loan to value. So HELOC is structured into two parts, the first being the draw period. This is when you decide when you want to withdraw your funds, and you typically only make interest-only payments during this time. Then there's the payback period, when you can no longer withdraw funds and you must pay back your HELOC. So the advantages of a HELOC compared to a cash out refinance: during the draw period, you get to withdraw funds when you need them, and you can choose how much you want to withdraw. So if you have $100,000 on your HELOC, but you only need $25,000 as the down payment for that next rental, you can withdraw only $25,000. Now, sometimes there is a minimum limit imposed by the lender as to how much you have to withdraw. but you don't make payments until you go to withdraw those funds. And the beauty of HELOCs is once you pay the HELOC off, assuming you're still in your draw period, you can continue to use the HELOC over and over again. Now, seasoned real estate investors will typically use the HELOC for a short-term funding, i.e., they'll go purchase a property to then flip or BRRRR and then pay off the HELOC within a couple of months. Now, this is not recommended to use for things other than assets. And again, once that HELOC is paid off, you can continue to use it over and over again. In closing, cash out refinance and HELOCs are very powerful tools. When you use them right, you can use your same money over and over again to build and expand your real estate empire, to obtain long-term wealth, passive income, and ultimately financial freedom and/or financial independence. That's all for this one. If you enjoy this content, please like and subscribe. And until next time, take care.